Good evening, and today is the second week of 2026, and we're going to be doing a recap of what happened the week before. Today, of course, is January the 18th, and this is the second full week of trading for the year. Now, let's get started. Now, before we get into the content itself, let me remind you that this presentation is for informational purposes and it does not constitute an investment or financial advice, and it is not intended to be an offer to buy or sell any kind of securities, be it futures, FX, CFDs, and whatnot. Okay, this presentation may contain forward-looking statements, including my opinions, forecasts, expectations, and conclusion based on current views and assumptions. These opinions are subject to known and unknown risks and uncertainty, which could cause actual results or events to differ materially from those expressed or implied. Now, this presentation is also general in nature and does not constitute a professional advisory relationship between you and me. Attendees should consult a qualified financial advisor before making any kind of financial decision. Now, with that out of the way, let's do a bit of a recap as to what transpired the week before. Last Saturday, on the 10th, we have President Trump actually ordering two agencies. And I remember these two agencies was very prominently featured during the 2008-2009 financial crisis. They are Freddie Mac and Fannie Mae, and they have been taken into as a government agencies purely to absorb all the mortgage-backed securities that was the culprit that caused the property market to collapse in the States. And now what President Trump intends to do is to basically bring down the mortgage rate, and he thought that this would be a good idea to get a two agency to cough up $200 billion to buy these MBS, so-called mortgage-backed securities, in a bid to force mortgage rate to come down. Of course, this has not become law just yet. This is just one of his many suggestions. And if it's finally get through to Congress and it become law, then it may actually have a direct impact on the mortgage loan rates. Okay. Now, on Sunday itself, we have again President Trump calling for banks to cap their interest on credit card balance to 10% for 1 year. So this is not very welcome. In fact, that was the catalyst in which we see equity market comes off on the following Monday itself. So this has been something that is very, very unpopular with the banks, and that actually caused bank stock to actually come off midweek. Now, on Monday itself, we have news that the Department of Justice has served the Federal Reserve with subpoenas. Basically, what they are trying to do is to take down the Fed chairman Jerome Powell, okay, because of allegation of impropriety for the renovation of the Federal Reserve buildings. Okay, so we all know this is a political ploy to actually get the Federal Reserve to cut interest rates. So on Tuesday, the inflation numbers came in. We had the CPI numbers. They came in lower than expected, and as a result, we see equity markets in terms of the Dow Jones and the S&P 500 both traded to fresh all-time high. We also have crude oil actually surged to an 11-week high based on the possibility that the U.S. is getting ready to attack Iran again. Okay, and this has been largely due to the fact that President Trump has been warning the Iranian regime not to kill the protesters. There were unconfirmed reports that as many as 2,000 protesters were killed. And President Trump says that telling the Iranian that to continue the protest because help is on the way. So the market interpret that as U.S. getting ready to intervene militarily in Iran. On Wednesday, we have retail sales number. It came in solid, and that was a good number. However, when we look into the control group, it does not suggest that this is the case. Although the headline retail sales number is actually very strong, going from negative 0.1 to 0.6 positive. That is a very, very good number. However, when we look into the control group, that is not necessarily the case. So on Thursday, we have again President Trump threatening to invoke the Insurrection Act to suppress protesters in Minnesota. Now, a week ago, we knew there was some ICE agent killed a woman who is in her car, who did not stop when asked to do so. So a ICE agent actually shot and killed her on the spot, and that caused massive protests in Minnesota. So now the President Trump is calling in the National Guard to basically come in to suppress the very violent protests in Minnesota. Okay, and then on Friday we have President Trump again appear to back off from a suggestion that he is going to be getting ready to launch an attack on Iran. And basically, that has been an excuse because we knew that certain Middle Eastern countries has been putting pressure on President Trump not to do it. Countries like Qatar, UAE, uh, 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 Bahrain, Oman, we can see that these are the countries that has been telling President Trump, together with Saudi Arabia, saying that any kind of attack on Iran is not going to be very, very fruitful. Okay, so this has been what have been transpired in the past week itself. Now, so let's take a look at the various markets. As far as equity index futures is concerned, we can see that in this particular series, I'm going to expand the coverage of the equity index beyond the US four major equity index to cover a little bit more Asia-centric indices. Okay, for that we will get going. So the first news that came in, of course, earlier on, I did mention that the Department of Justice has actually subpoenaed the Federal Reserve Chairman largely on the transparency over the renovation cost for the Federal Reserve building, and that has been their motive to actually pressure the Federal Reserve to cut interest rates. Okay, and the Fed chairman did not take this lying down. He actually had a press conference, and he did not mince his word, saying that this is a political move and largely to get the Federal Reserve to cut interest rates. Okay, so there has been a lot of support for the Fed chairman from people in Congress as well as other central bankers in other countries. Okay, JP Morgan said that the proposal to cap credit card balance interest rate to 10% is not helpful. In fact, it could actually hurt consumer as well as the economy. Now, there are certain large retail banking group that has a very large business in issuing credit cards. And we all know American consumer to a large extent has been living from paycheck to paycheck. And there are many who are actually dependent on credit card to roll over for their cost of living. So having the banks limit their earnings to 10% a year would actually present a disincentive for the bank to roll out more credit cards and to provide credit to consumers. So this is the reason why the banks have been coming out to say that this is counterintuitive and it may actually be a disincentive for the bank to continue to want to be in the business. They may rule out less credit facilities, meaning to say at the end of the day, the consumers don't spend, the economy will also suffer. So this is something that is still ongoing. It is still not a law just yet, okay? It's just a proposal at this moment in time, but that has already shaken the banking stock. We see on average, major banks stock has actually seen their value drop by 4% on average this past week. Now, the first few data that came out was the CPI numbers. Now, inflation on the retail level year over year, we can see that it has really not moved a lot. It was 2.7% in November. It is still 2.7%. However, when we take into the core CPI numbers year over year for December, meaning to say we take away the cost or the energy and the food prices, we can see that it is stable at 2.6, although the market did expect marginally high at 2.7, but it came in the same as November. So it did not really move. Now, in the chart below here, we can see that there is a gap in between October, in which there was no data collection, largely due to the government shutdown. And we can see that based on that trajectory that we knew, that the market has actually hit a high of 3% for both the headline CPI as well as the core CPI. Now it is at 2.7, 2.6 respectively. It suggests that inflation has come down. So is this the case? We will take a look into the producer price index next to take measurement as to really whether inflation is coming down. Now, in the producer price index, which is trying to measure inflation at the wholesale level, we can see that the situation is not congruent to what we are seeing in the CPI numbers. Here we have core producer price index for 2 months in October and in November, and they were both released on the same date on Wednesday. So we can see previously it was 2.6 in September, and now we have the October number being released is at 2.9. So there is a 300 basis point move. Okay, so this is not good. So we have 2.6, now it's 2.9. Now in November, we do not have the number for November, but we knew that the market expectation was 2.7 for November. It came in at 3%. So when we measure this set of numbers, we are seeing that the PPI numbers, which measures inflation at the wholesale level, is on the rise. Okay, so this is a more accurate reflection of the true state of inflation in the United States. Here we have retail sales, and retail sales has always been a major number to watch because 70% of US GDP is made up of retail sales. Here we have retail sales, which is month over month for the month of November, it came in at 0.6. This is a lot better from the revised number of negative 0.1% in October. So we can see from negative 0.1 to positive 0.6, that is a big jump, suggesting that retail sales is still very resilient. So that should actually be showing us that US consumer is still spending. However, when we look into the control group minus a few items, which is essentially exclude the receipts from auto dealers, building materials, retailers, gas station, office supply stores, as well as mobile home dealers, as well as tobacco stores. So when we take away these 6 items, we see that the control group was at 0.6% in October, now it's only 0.4. So it did not jump like the headline month over month numbers. In fact, it has gone down by 50%. So this is not a good development. So it suggests that the US economy is not out of the woods just yet, just because the month over month retail sales does show a massive pickup from where it was the month before. So we can see that it is a big number, but when you look into the core, look into the control group, it is very obvious that retail sales is not as robust as the month over month number suggests. Okay. So this is the Dow Jones, the cash index. Here we can see that the cash index in the Dow Jones is still very much in the bullish phase. We have an all-time high traded at the beginning of the week itself at 49,633.35. And this is suggesting that by and large, the growth stock, which is what the Dow Jones is all about, is still very much in that bull phase, although we have a very minor potential counter trend in place. Okay, whether that will result in lower prices, even if the Dow Jones actually come off, unless it comes off very sharply, it should be taken as a normal technical reaction. Okay. So here we have the S&P 500. Again, this is the daily time frame for the S&P 500 cash index. Very similar to the Dow Jones, we have an all-time high traded at 6,986.33 on Monday. And that has been a record high. Very similar to what we see in the Dow Jones, we also have a ongoing counter trend in place, which may actually be a technical retracement if the market trades lower the following week. Here we can see that the market is basically still very much in favor of the bullish outlook. So any kind of pullback should be seen as, for now, just a technical correction. Okay. In the Nasdaq 100, the chart here looks very different because the all-time high traded at 26,182 was actually traded on October 29, 2025. So it means that the Nasdaq 100, having led the Wall Street higher throughout the whole of 2025, actually peaked 2 months before the Dow Jones and the S&P 500. So what we are seeing here is a potential correction. The market has attempted to rally, but the highest traded again was on Tuesday at 25,873.18, and it closed the week slightly lower. That could also result in lower prices in the coming week. If this is a corrective pattern, there is a possibility the market will go lower with the initial target at 24,891, perhaps even have the possibility of trading marginally below 23,854. Now, however, if the low at 22,959.7 is not taken out, by and large, this is still seen to be very bullish and it could present a buying opportunity, technically speaking. Okay. Now, in the Russell 2000, this has been the index that has been doing very, very well since the start of 2026, purely on the expectation of lower interest rates. Now, the Russell 2000 is a small cap index, and they are very sensitive to any kind of interest rate movements. If the expectation is that the Federal Reserve will continue to cut rates, the Federal Reserve has already cut rate 3 times in 2025, and expectation is that there will be more rate cuts into 2026, although nobody knows for sure whether one will actually appear in this month. Okay, this will represent the first FOMC meeting for 2026. Expectation is not very high. So that aside, if the expectation is that the Federal Reserve will continue to cut interest rates, it will largely benefit the small cap index, which is what the Russell 2000 is. We can see that unlike the other three major equity index, the Russell 2000 registered all-time high on Friday at 2,692.22. Okay, and we can see that in terms of year-to-date gain, this has been the best performer so far this year, with a gain of 7.89% in just 2 weeks of trading. Compare that to, let's say, the S&P 500, it only gained 1.11%. So we can see that by and large, the small cap has been taking the lead. And this is something that we want to continue to watch. Maybe this year, instead of trying to trade the other three major equity index, maybe the money is in small cap. So if we do see a decent pullback, maybe that would be a great chance for us to actually consider positioning for further rise in the Russell 2000. Now, across the Pacific, we have the Nikkei 225. Here we can see that based on the new Prime Minister Sanai Takaichi's fiscal policy, we can see that she has actually proposed and the Parliament has actually approved a massive stimulus package in the vicinity of 789 billion US dollars. So the market is very excited about the stimulus effect on equity markets. So we can see that the Nikkei is trading at record high on midweek itself at 54,570 before closing the week at 53,720. So we can see that the Nikkei 225 is very, very bullish. And if we do see a pullback, two areas to look out for will be the 52,700 levels and the 51,120 levels. These two levels have exhibit previous support before. So we can see that the upper line here at 52,700 act as a resistance. Now that the price is above this line, it will act as a natural support. Now the other line below it is 51,120. Okay, that line has also been a major resistance. Now the market has punched through. When it pulls back, you can see that it sits very neatly on 51,120. So that leads to the possibility that these two lines could act as a immediate bottom if the market do pull back. Okay. So over in Asia, we can see Hang Seng has actually been doing very, very well throughout the whole of 2025. And it is no difference here. We can see that Hang Seng has gone into a bit of a consolidation. The high traded was 27,381. There were three attempts to rally, with the one very latest on Thursday at 27,206.8. Okay. While the market has been very reluctant to go higher, obviously they are very cautious. It created what we could be calling a triple top. Now, a triple top is potentially a bearish development. If that is the case, you cannot rule out the possibility of lower prices in the Hang Seng. But by and large, the directional buyers for the Hang Seng on the daily time frame still support higher prices in the medium to long term. Okay, so if there's going to be any kind of pullback, immediate target could be looking at 24,000 thereabout. Okay. Over in China, the 850 is a blue chip index. Okay, very much in the same mode as the Dow Jones index here. Here we can see that the premier index has also been going up, and the all-time high traded is 16,322. And most recently, as far as 2 weeks ago, we can see that the attempt to rally has been kept at 15,732, with a little bit of a potential continuous pullback here in a technical correction. Okay, so the Chinese market has been benefiting from the stimulus package that has been rolled out in China. China has actually been trying to encourage Chinese companies to actually invest more. And it has also attracted a lot of foreign funds coming into Hong Kong through the Connect. Okay, so we can see that by and large, the Chinese equity market has done very well the whole of 2025. Will that be the case in this year? I think the momentum should be able to carry through because nothing much have changed. Okay, so continue to look for lower prices as an opportunity to see if we can actually look to position on the buy side for further rise in the Chinese equity market. Here, I also included for this week the KLCI, which is the Malaysian Equity Index. Here we can see that very much like the Russell 2000, the KLCI is at a record high on Friday at 1,721.5. So this is very, very near to my projected target at 1,763.7. So by and large, this market continues to look very positive. Technically speaking, continue to look for buying opportunity if you can, because I think this market is basically very, very bullish, largely because of the 13 Malaysian plan, which includes the special economic zone in Johor Bahru, neighboring Singapore, as well as infrastructure prospects in Penang. So we can see that it is also a year whereby Malaysia is promoting the Visit Malaysia year, and that should actually drive the tourism sector as well. So by and large, we can see that the Malaysian economy is doing okay for now, okay, and that should spill over into equity markets. Now, the last index I'm going to cover will be the Straits Time Index. Here we are talking about the Singapore Index. It has just hit its target. The target was 4,842.3. It came into the high of 4,849.1. Again, very similar to what we are seeing in the KLCI. This market is very, very strong, largely due to the fact that the Singapore economy actually was very, very firm for the whole of 2025. And it does looks like the prospects of further gains may be in store for the local bonds. Okay, here this is the outlook for the Asian equity markets.